In this lesson, we're going to talk about the statement of cash flows. Statement of cash flows is our fourth and final financial statement that we really haven't been able to spend a whole lot of time on, really, up to this point. So what is its purpose? Well, no financial statement that we've looked at this point really tells us how our cash movements affect our financial statements. A lot of people confuse the income statement with what cash should report, because the income statement shows us revenue that typically feels like it should be money coming in, and then expenses, which kind of feels like money going out. But we know that because of the rules in accrual accounting, that those sales revenues can be recorded even though the customer hasn't paid us yet. So it doesn't really indicate all money coming in. We also know that because of accrual accounting that those expenses can include payables that we still owe to someone. So it doesn't really show money going out. And then where do we report the fact that we pay money for something like equipment, right? That's on the balance sheet. So the statement of cash flows really is to help us show how we receive cash, how we spend cash, and then what the change in the cash balance truly is. So why is it important? Well, because it explains that change in cash balance. Do you think that knowing where your cash is going is a good idea? Yeah, absolutely. But really, primarily, there's not much different on the screen with the exception of that lower right box that says, why do income and cash flows differ? A lot of unknowing business owners believe that the income statement really should show them or reflect how well they're doing with their cash, and it's just not true. It is going to be different, and it's primarily because of receivables and payables. So when we measure cash flows, we again have to think about what cash really means. What is cash? Remember, cash isn't just dollar bills and coinage, right? It's anything that is short-term, highly liquid, and readily convertible into cash, which could be checking accounts, CDs, it can be short-term bonds, just about any of those things we call cash. So when we talk about cash flows, we also talk about categorizing them or classifying them into three primary sections of the cash flow statement. Those are operating activities, investing activities, and financing activities. And we're going to see all three of those sections directly on the front of the cash flow statement. And whether the section has information in it or not, all sections must be available to be a proper cash flow statement. So let's look at the operating activities. Well, if you look at a few of these, you'll see sales from customers, sales from securities, receipt from revenue. Over on the right, you've got buying securities, paying out interest, paying operating expenses. All of these things are things that you would typically think of that would hit the income statement. Revenues and expenses. All of these things would end up hitting our income statement. So really, the operating activities section of the cash flow statement is going to deal with cash inflows and cash outflows that pertain to operating income. What about the investing activities section? Well, looks like I've got inflows from selling property, plant, and equipment. That's vehicles, buildings, land. Long-term investments, principals on notes. Maybe I want to loan money in return for notes receivable, buying property, plant, and equipment, buying long-term assets. What are we talking about? We're really talking about cash inflows and cash outflows from the purchase or sale of fixed assets. How about financing activities? The third and final is basically anything that didn't hit operating and the investing section, but the financing activities are going to pertain to any inflows and outflows that deal with loans or any types of cash inflows or outflows to and from our owners or our shareholders, as it would be, like stock contributions by owners for owner's equity if it's a sole proprietor, things like that. Can there be anything else? Yeah, sure. There can be non-cash investing and financing activities, and you see a list of the types of things that are down here, but a cash flow statement is a monetary statement. It typically doesn't have this non-cash stuff on it, but these certain non-cash investing and financing activities should be disclosed in the financial statements. All right, So how do we prepare it? Here's kind of what it looks like. Remember, I said that even if there's no information in a particular section, you've got to have the section listed in order to make it proper. First, we list our cash flows from operating activities, and by the time we figure all that out, it's either going to show us net cash provided by, which would be a positive number, or net cash used by, which would be a negative number, operating activities. Same thing from investing, same thing from financing, and then we add those three classifications up, and that should tell us what our net increase or decrease in cash was for the period. And simple enough, if it's a positive, it's a net increase, and if it's a negative, it's a net decrease. And then we look at our cash balance at the prior period end, we add into it our net increase, and that should be our cash balance at the current period end. Alright, so here's the steps that we look at. First, we compute the net increase or decrease in cash from, it says overall cash, right? So we're going to look at the balance sheet for step number one. What was cash last year? What is cash now at the end of this year? What's the difference? Because that should be our net increase or decrease in overall cash. Then we compute the net cash from operating activity, step two. That's probably the hardest part, and it really is the crux of the entire lecture, is how to deal with operating activities. Then we compute net cash from investing activities, a lot easier. Net cash from financing activities, also a lot easier. And then we prove and report the beginning and ending cash balances. Basically, step 5 should tell us the exact same thing that step 1 tells us. So if we were to just analyze the cash account, I mean, why can't we do that? Let's just analyze the cash account. And here's a very simplistic view. This is from an old piece of accounting software called Peachtree. But if you look at the cash account, look over on the left. That's cash inflows, right? We know that those are debits into cash. That's cash coming in. And it's real nice that they've kind of given us this summary here. It says, okay, we had receipts from customers, receipts from asset sales, and receipts from stock issuance. Flat out, I can tell you right now that from customers is an operating inflow, asset sales is investing inflow, and the stock issuance would be financing activity inflow. Look over on the right, payments for inventory, payments for wages, payments for interest, payments for taxes, payment for note retirement, payment for dividends. Can you see all the sections there as well? Sure. Inventory, wages, interest, and taxes, those are all operating activities. And then the notes and the dividends are both going to be financing activities. Doesn't look like we have investing activities. Well, why can't we just do this? Well, it just doesn't work that way. When you look at a cash account, you actually see every single transaction that makes up these summed numbers. So it certainly doesn't work that way, if only it were that easy. So we have to analyze any non-cash accounts, and that's really what we have to do, is we have to analyze non-cash accounts. Well, there's only a few cash accounts, and they're assets, right? We know that they're up on the balance sheet at the top. So we don't worry about the cash accounts of the balance sheet. We worry about the non-cash asset accounts, and then we look at the liability accounts and the equity accounts. That's how we're going to deal with it. The information that you must have in order to prepare this statement is, one, a comparative balance sheet. It has to be comparative. You can't just use a balance sheet from this year. You've got to have a balance sheet from this year and last year. And the reason is because, number one, you have to be able to compute the difference in cash to make sure that you're doing this right. But there are a few other accounts that we also need to look at the difference in. Must have a current income statement, and then of course there's always going to be some additional information. Let's just look at this one little practice problem I need to know on classifying cash flows between operating, investing, or financing activities. So you see a few different things here, like purchasing equipment, cash payment of wages, issuance of stock for cash. Let's kind of see if we can go through these, right? Remember, operating activities are our day-to-day cash receipts and disbursements, usually stuff that happens on the income statement. Investing activities are cash inflows and outflows from the purchase and sale of long-term assets, and then it says, and any non-operating short-term investments. And then financing activities are inflows and outflows related to long-term liabilities and equity. Let's see what we can do. So, here we go. Operating comes from, you'll see their assets and current liabilities, basically current assets and current liabilities. Investing is going to come from long-term assets. Financing is going to be long-term liabilities and equity. Here we go. What do we think about A, the purchase of equipment for cash? Well, gosh, where is equipment belong? Is that an income statement thing? Is it a balance sheet thing? Which one is it? Okay, and you'll see here is where we come down to. That purchase of equipment is an investing activity because it's the purchase of an asset. Remember that? Look at B, cash payment of wages. Wages are an operating activity. That salaries and wages belong on the income statement, so it's an operating activity. Issuance of stock, that's an inflow or outflow between us and the owner of the company. Financing activity. You can see how all of these just basically get separated. These are all the cash transactions, and each one gets categorized in the appropriate place. All right, so cash flows from operating, like I said, that's where the crux of this is going to come from. It really is the more difficult part. There are two methods of determining cash flows from operating. One is the direct method, which we find to be really, really hard because you have to kind of go in to your cash account and analyze all of your transactions. Remember that summary sheet that I showed you from Peachtree? This is kind of how it was laid out. But this is just not how accounting software works anymore. We don't see summaries like this. It's really hard to find. Instead, when you look at a cash account, you're going to see individual cash deposits, individual cash payments. Well, I mean, if you have 300 transactions a month, that can be kind of hard to do. So we don't see many people doing the direct method anymore. And typically what happens, even within software, is that we see the indirect method. And the reason even software shows us the indirect method is because it's what most accountants use and what we're used to seeing. The indirect method starts with net income. It starts with net income. Why? Well, we are talking about operating activities, right? And operating activities we've already determined are usually cash inflows and outflows that relate to net income. But net income is the addition of revenues minus expenses that could come from the accrual method of accounting, which means some of our sales we may never have actually received cash for. It might be stuck in accounts receivable. And some of our expenses we may never have paid for yet. It might still be stuck in accounts payable. Okay? And then what about prepaid expenses? Prepaid expenses are those things that we paid for up front. They're sitting on the balance sheet and haven't hit the income statement yet. Okay? And then interest payable, income taxes payable. You'll see there's a few. What about depreciation? Have you ever purchased depreciation? You can't go to Walmart and buy depreciation, folks. I don't know how hard you look for it, but you can't buy depreciation, which means you can't pay cash for depreciation, but isn't it an expense that lowers net income? And the answer is absolutely. This line item lowers net income. So it's something that we have to deal with as we try to get this number closer to a true cash balance. All right, see if we can take a look at it. We're going to do the indirect method. We don't do the direct method in this class because it's really a more of an intermediate accounting topic. It is in the appendix to the chapter, so you might want to just look through that, make sure that you understand what the direct method is. I know for one of the classes that are viewing this lecture, the direct method will be covered in a group topic, which is our LRSP class. So we'll see it in a group setting, but we're really not going to lecture on the direct method at all. All right, so here's the things that we need to help us do the indirect method of the operating activity section of the cash flow statement. First, you've got to have a comparative balance sheet. And you'll see here we have balance sheet for year ending 2015 and 2014, and they've gone ahead and been nice to us, and they gave us what the change was from year over year. So cash has increased by $5,000 between 2014 and 2015. It's gone up by $5,000. Look at accounts receivable, gone up by $20,000. Look at accounts payable, it went down by $5,000, right? Interest payable, looks like it went down by $1,000, okay? So we've just looked at this change year over year because we're going to need that information. And then here's our income statement. See that net income starts with $38,000. Now, do you remember the things that we needed to deal with? Yes. We don't look at the change in cash because this is what we're trying to prove, right? But we do have to deal with the non-cash changes in assets, the non-cash changes in liabilities, and the non-cash changes in equity. Those are the things we have to deal with. What are the non-cash changes in current assets? Operating, and liabilities, operating. Non-cash changes in long-term assets is investing, and then non-cash changes in long-term liabilities and equity is going to be financing. All right, so when we apply the indirect method, we also need additional information, right? So here's the accounts payable balances. It says it all comes from inventory. We purchased $60,000 in plant assets by issuing some notes. We sold plant assets with book value. We received some money from issuing stock. All these great things. Let's see how this works. The first thing you have to know is that you have to do this as a process. You must do this as a process because otherwise you're just going to get lost. They've kind of got these numbered incorrectly because typically we deal with this one first, this one second, and then we kind of go back and look at this one. I think it's just numbering, right? But we have to look at the changes in current assets and non-cash current assets and current liabilities. Sorry, I can't talk today. Then we look at our non-cash expenses such as depreciation and amortization. We're going to always add those back. Why? Because these expenses reduced net income. They reduced net income, but they weren't real. They didn't result in cash, right? So we have to add those back in. Same thing with losses and gains. Then we deal with these changes in assets and liabilities, and that will get us cash flows. Let's see what this looks like here. When we're dealing with those changes in current assets and current liabilities, it's just best to memorize the rule. This can be kind of tough to think about for a while, but if you have an increase in current assets, like accounts receivable, if accounts receivable increased by $2,000, we want to subtract that from net income. But if it decreased, we want to add it to net income. You might be, well, that's convoluted. It feels convoluted, but why do we do the opposite? Well, because if accounts receivable increased, it resulted in sales on the income statement that we haven't received cash for. That's why we have to take it away. And if accounts receivable has decreased, it means that we've received money, right? We've received cash for income that had maybe already been recorded, possibly in a prior year, which is why we have to add it. If you don't get that, right, if that didn't sink in and it's taken some time, memorize this rule. For the change in current assets, do the opposite. Why do I say that? Well, if change in current assets is an increase, subtract it. Do the opposite. If it increases, subtract it, right? If it decreases, add it. So the rule of this, how I got through it, I'm going to be honest with you, I didn't get this stuff. I had a really hard time understanding this when I got into intermediate accounting as well. So I just memorized the rule. Current assets do the opposite, current liabilities do the same. Why do I say that? Because if it's an increase, we're going to add. If it's a decrease, we're going to subtract. Okay? Current assets do the opposite, current liabilities do the same. Just memorize the rule. It can be hard to get. So what's the first thing we're going to do? We always start the operating activity section with net income. There it is. It was $38,000 on the income statement. That's what it said. Okay? Do you remember that? I'm going to go back and just find that slide number real quick so we can go back and forth between it. And let's get to that. There it is. Okay? There's net income. It was $38,000. And then the very next thing that we saw was that it's going to deal with depreciation and loss on sale of plant assets and gain on retirement. Look at what it's doing. It's adding back depreciation expense and adding back the loss on the sale of plant assets. Okay, well, there's depreciation expense. We got to add that back, and then we've got to add that back as well. This is just like an expense that we have to add back. And then it says that we're going to take away the gain, right? So we add back our non-cash expenses and we take away our non-cash gains. Why are these not really going to result in cash? Well, you know you can't buy depreciation, but what about the loss and the gain? These are arbitrary numbers dealing with your book value, right? Not only that, but the sale of plant assets is an investing activity. And the gain on retirement of notes is probably going to be more held like a financing activity. They're not operating activities at all, so we need to take them out of that section. All right? So we end up adding back our depreciation, adding back our loss, and taking away our gain. And then we've got to start dealing with the change in non-current the change in non-cash current assets and current liabilities. Well, the first one it says is, hey, accounts receivable was on the increase. Let's look at that real quick. Here it is, accounts receivable was a $20,000 increase. What's the rule? The rule is that for current assets, we do the opposite. See that? If it was an increase, we subtract it. What about inventory? It says increase. There it is. Increase in inventory was $14,000. It's a non-current asset, or a current asset, so we're going to do the opposite. Prepaid expenses, current asset, do the opposite. It was on the increase. And then look at accounts payable. Isn't that a non-cash current liability? Yes, it is. And what's the rule? The rule was to do the same. Because it's a decrease, we're going to take it away. Let's go look at it. Here's accounts payable. It went down by $5,000. And the rule is do the same. If it decreases, subtract it. So we're subtracting it. Same thing with interest payable. There was an increase in income taxes payable. I do the same. Increase means I add it in. So once I take all of these things into account, you'll see that I now can calculate my net cash provided by operating activities. Why is it provided by? Because it's a positive. $38,000, and then we take all of this into account, gets us down to a positive $20,000. That means it's net cash provided by. If this were a negative, it would be net cash used by. All right. Then we get into some of the other stuff as well. This is just the summary of adjustments for the indirect method, and that's the only time we use indirect. It only has to do with the operating activities section. Once we're done with operating activities, we go into investing and financing, and it gets a lot easier. So let's look at investing and financing. The first thing a publisher is going to tell you is that this is a three-stage process, and I think that's a bunch of baloney, right? It says identify changes in invested relating accounts and explain these using reconstruction analysis. What are you talking about? Is this botched or something? No, you don't have to go through all of this. And the truth of the matter is that investing transactions are large enough that they're very easy to identify and find in our financial statements or in our transaction details. Same thing with financing activities, very easy to determine whether cash was used or provided by. If we were actually doing reconstruction analysis, and you'll see what happens is they want you to go back and reconstruct what the journal entries looked like. That's what they're talking about. Let's just see what they're saying, and I'll show you why I think that's a bunch of baloney. This analysis reveals $40,000 increase in plant assets from 210 to 250 and a $12,000 increase in accumulated depreciation. Well, maybe your gut says, well, if it increased by $40,000, I must have bought $40,000 worth of equipment. And you know that's not true because you could have borrowed money for that. Not only that, but you could have bought something and paid $160,000 for it and then taken $120,000 off the books because you sold something. So this just doesn't work. Looking straight across, you can identify that there's a change, but you really can't identify what the cash movement was. My thought is that these transactions are large enough that if I go look at the detail behind these numbers, if I go look at the general ledger account for plant assets, I'm going to quickly see what that transaction was and be able to find the journal entry to tell me exactly what happened. Look at what happens in item B. In the additional information it says, Genesis purchased plant assets of $60,000 by issuing notes payable. Was there cash involved in this? No. Okay, I'm done. I don't care about it anymore because there's no cash, so I'm not even going to fool with it. But then item C reports that we sold plant assets costing $20,000. You see what happens? I put $60,000 on the books. I took $20,000 off the books, and that's why we had a $40,000 change in that plant asset account. Okay? Do you remember that? Let's look at it. $40,000 change in plant assets. I have no idea what slide that was. Let's see if we can get back to it. That's that $40,000 change. But that's not what happened in cash. When I went back into the general ledger and looked, I realized that, oh, I borrowed money here, and now I sold something and I got paid $2,000 cash. I'm done. I don't need anything else. I certainly don't care about depreciation. That's over with. The only thing I wanted to know was what cash got used, and I can see that right here. Why did I have to go through all this? Because it's easy enough to see that there's only a couple transactions in the entire account. And when I go find those journal entries, I can easily pick out the cash piece and be done with it. It's a $2,000 issue. Then I move on to financing. And that was it for investing. We're done. Move to financing. It says it's the same three-stage process. And I say that's, again, it's a bunch of malarkey. Why? Because financing is about borrowing money, about issuing dividends, and about selling stock. That's what financing is all about. And these transactions are going to be very, very easy to see. Again, if I go with the publisher and try to do an analysis, I see that there's a change in these accounts. What explains the change? Well, if I go look at the accounts, I'll see that here I had a note with a carrying value, and I ended up paying out some cash, right? $18,000. That's the only part I care about. I don't care about anything else. Here I issued out some common stock. What did I get? Cash. Only thing I care about. Issued dividends. Cash. Only thing I care about. It's so easy to find. I don't even need to do reconstruction analysis. Okay? Let's put all the pieces and parts together. Here's the operating section, right? I started with net income and I ended with $20,000 cash provided by operating. Then I moved to investing. I only had one thing to deal with. I received $2,000 from the sale of assets. That's net cash provided by investing activities. And then I get to financing. I had 3 different transactions, so I have net cash used in financing. It's a negative $17,000. $20,000 plus $2,000 minus $17,000, and I get a net increase in cash for the whole year, a net increase in cash of $5,000. Okay? So then it says, all right, well, if you increased in cash by $5,000, what was cash balance at prior year end? It was $12,000. Where did I get that from? The balance sheet, right? So I had $12,000 when I started this year. I added $5,000, which means my cash balance at the end of the year should be $17,000. Is that what the balance sheet says? I don't know. Let's go look at it. It was a $5,000 increase, and I ended with $17,000. It's perfect. That's exactly what that cash flow statement is supposed to show us, is that it matches up with what we have on the balance sheet. It's a self-proving report. And that's going to finish out Chapter 12.